Good morning. Hi, I'm Ben Haskin. I'll introduce myself. I'm Ben Haskin from Wilkie Farr and Gallagher. To my left is Alan. You want to introduce yourself?
Oh, sure. Hi, Alan Shao, Deputy Chief Risk Officer for Amundi US.
Hi, I'm Brad Wilson. I'm a counsel at MFS, and I handle mutual fund and UCITS issues, but also have been tracking global sustainability developments the last year and a half or so.
We're here to talk about some of the ESG developments and where some things are going in the ESG world, as particularly from a regulatory and compliance perspective. So we'll talk a little bit about some of the regulatory agenda and some of the other standards that apply, some of the compliance considerations, and of course, at the end, we'll have some key takeaways and questions. Just to do a brief overview, we've all seen a great growth in ESG investing for a variety of reasons, I think, and I'm going to turn to my panelists in a moment, and they'll talk a little bit about some of the growth that they've seen in the various types of ESG investing. And we know that it has evolved and it has become much more complicated than it was just a few years ago in many ways, because the strategies have become much more subtle, and there are many more external parties participating, either by providing standards or providing information that can be used in ESG investing. I don't know, Alan, if you want to start us off a little bit by talking about the growth from your perspective.
Yeah, sure. I work for Amundi. We're the largest asset manager in Europe, so obviously there's a lot of heritage for us for doing ESG, SRI, similar things. Now, what we've seen is the ESG momentum is clearly accelerating, but everybody's looking for that magic number, how much assets are ESG. You've seen different numbers, $30 trillion or 50 or whatever, but number can be misleading because what doesn't tell you is how much of this ESG committed versus ESG implemented. And also, we also have the elephant in the room issue where what is the definition of ESG? There isn't really a legally agreed definition, but the momentum seems to be accelerating anyway. Now, the common understanding is ESG is sort of a trade-off between morality and money, pure financial incentive. So there has to be a trade-off. When the pandemic first hit us, and the understanding is there will be some kind of a trade-off, some kind of a deceleration of ESG because people care more about financial motive more during during panic, during market stress. But the opposite actually happened since 2020. The pandemic not only didn't slow down the ESG momentum, but actually accelerated it. Now, the other thing is I work in the risk management space, so I witnessed the ESG has moved from a more of a risk management concept to now today more like investment management concept. The strategy, as Bill mentioned, is more granular. Mostly there are three categories. We're going to talk a little bit about the compliance challenge and legislation in audit area. The first area is more exclusionary based, which dates back to similar like social screening, SRI type, dates back to the tradition of some religious organization particularly. Now the values may evolve, but the approach is very similar. The second category is more we call ESG integration. So a lot of vendors, MSCI, ESG ratings, oftentimes you see investment teams start incorporating ESG rating either in their research process or in the investment decision process, a mixture of the two. The last category is what we call thematic investing, or we call impact investing. And these are the strategy with usually dual objectives. So one is for impact objective, how much the water improvement, carbon improvement, and the other is traditional financial objective, and then the interaction of the two. So this area overlaps quite a lot with, there used to be philanthropy areas, except now it's a mixture, it's more balance between purely financial incentive and some purely impact objective. So there's definitely a generational shift. We've seen different surveys, millennials care more about social issue, environmental issues, so they're part of the driver for the demand.
Yeah, and I will just add to that too, just the growth in these products. I think I saw a stat the other day and this is from last year, that currently I think in the US there's over 800 ESG branded funds at this point, representing I think 2 to 3 trillion in assets. And ESG is something that's not new, but it's obviously being promoted more and more. obviously clients want to hear about this stuff, and investment firms want to provide clients, with what they want ultimately. So I think you're seeing a lot of repurposing of existing funds into ESG funds, and that certainly creates its own issues. And then you have these kind of new strategies and shops getting into, all the strategy types that Alan had mentioned, and launching and bringing new funds to market. So it's certainly a trend that continues not only in the U.S. but also globally.
And I think we'll see as a theme as we go across this panel that because there are different types of ESG and customer understanding of that varies, the importance of really understanding the different strategies that could be employed and how it may be reflected to investors, because, in our experience, I think there are varying degrees of investor understanding, and not all understand that the ESG label actually encompasses a lot of very different types of strategies within it. It's not a very precise label. One other thing on client demand, and I'll leave, my panelists can probably add to this. The other group besides the millennials is a lot of retirement plans. I think have, particularly state employee retirement plans, and public service workers, but others as well, have moved to looking for more ESG type investing, which is another driver, and certainly impacts on a lot of different types of accounts. So as you can see, we have a number of regulatory developments which we can explore in a little bit more detail. There are different parts of the regulatory framework have jumped in to provide or are in the process of providing either additional guidance or regulation. Just to do the overview, and then we can dig a little bit more deeper into the ones that most impact advisors. The Division of Corporation Finance is in the process of rulemaking where they will require greater corporate disclosures. From an investment advisor standpoint, that may be a good thing in many ways, because there'll be a lot more standardized information potentially available to evaluate individual companies. A lot of the corporate disclosures will likely will really revolve primarily around climate change and similar issues, but the SEC is clearly moving to more standardized disclosures in 10Ks and Qs. The Division of Examinations, formerly known as OC, has put out risk alerts, and it had a sweep last year, and we'll talk about that in a little bit. We know the Division of Investment Management is working on providing greater guidance on advisor and fund disclosure, and the chairman has spoken about this a number of times, about the importance of this for the names rule for funds, but also in some other disclosure contexts. And finally, there's an enforcement task force, something that makes all of us a little bit anxious, that are looking at advisor and fund disclosures and the management to see if there's any, effectively looking to see if people are properly disclosing and describing their ESG, as well as some of the performance aspects that go around that. Why don't we talk a little bit about the sweep exam? I don't know if either of you want to weigh in as to what you saw come out of the sweep exam from last year.
Sure. Yeah, I'm happy to kick this one off. So obviously, the Department of Examinations, we've obviously using the old terminology here with OC, has had ESG strategies used by advisors and disclosures as exam priority going back to 2020, 2021. I would bet my plane ticket home it's going to be on the top priority list in 2022. And they also announced, obviously, these ESG targeted sweep exams beginning in late 2020, which are continuing to this day, and probably many of us in this room have been subject to that. Out of that initial crop of those sweep exams, there's this compliance risk alert that was published in spring of last year, which I think for anybody in this room is definitely a must read. And this, like most risk alerts, this kind of notes common deficiencies that have been witnessed in these exams, and also some best practices. And there are really four key areas that the SEC and specifically OC picked up on One, do your policies and disclosures match your portfolio management and proxy voting practices? So are you doing what you say you're doing? Are there inconsistencies or even embellishments in your marketing materials related to ESG? Do you have an adequate and robust compliance monitoring program in place? And then also, what has an advisor committed to in the voluntary or international framework space? And how are you monitoring your compliance with that and making sure that you're meeting any obligations that you've committed yourself to?
Yeah, there are some examples here. For example, the compliance ESG policy and procedures. Oftentimes, there are differences between the investment policy, for example, the investment team want to achieve certain carbon goals and things like that being embedded in the traditional policy procedures. The question really is, do we have to create a separate ESG policy, or we just embed that component into the existing policy and procedures? There's lots of debate on that. The other challenge we're focusing on is the data, right? And oftentimes you hear a complaint, but the source of those complaints can be either the accuracy, like a data integrity, process integrity, somebody missing a data point, or the subjectivity of those data. Because if you have any of you seen these ESG ratings from the 4 major providers, they don't always have the same methodology. Example would be Tesla. If you look at the car, at the output, a great rating, but if you look at the entire process, it may not be that good. And then the European Union is trying to address some of that by defining scope 1, 2, 3 emissions. But there's a fair amount of subjectivity involved in this, which caused quite an interesting compliance challenge. But also the way the other part of it is how we prepare the disclosure. As Brad pointed out, a lot of firms are making disclosure. For example, the common thing we see is, example would be, let's say the investment universe are limited to the companies that get at least 50% of their revenue that align with UN SDG goals. There isn't very much a centralized governing body to verify that claim. It's okay, how do we know? So really up to the firm to develop their own desk procedure, so to speak, who's sourcing the data, who's checking them, who's validating them. So the overall point is, I know we're sort of an early inning in terms of regulatory development, but because the firm have already making lots of complaints, lots of claims, either for commercial purpose or otherwise, that there's already a lot of exposure there that the firm will need to be very careful when they make a claim, especially in a jurisdiction like the U.S. The burden of proof is always very high, much higher than European Union, for example. And then if we make a claim, how do we substantiate it, record keeping, so on and so forth. So.
Yeah, and I would just add, since we're talking about the policy issue, so again, making sure your disclosures and your policies actually line up with your actual practices. I think there's a couple good, just practical tips that are kind of no-brainers, but definitely are front and center here, is that when you're either putting together disclosure, whether it's for an ADV or a 40 Act fund, or you're designing your ESG policy, if you decide that you need to have one in place, making sure you have the right stakeholders weighing in. So you have the practitioners, you have your investment folks, your stewardship team, and also your compliance personnel at the table weighing in on these policies so they actually do reflect what you are doing, because that is something that you will get hammered on if you are getting examined. And then also I would say with policies very quickly here, we don't want to dwell on this too much, is the record-keeping provision, which obviously is usually a piece of a policy, and how challenging that can be. And Alan kind of touched on this a little bit in the ESG space, because it really kind of depends on the type of ESG strategy you're offering. Certain ESG strategies certainly lend themselves to documentation better than others. Think of something like an exclusion strategy. If you have a fund that has multiple exclusions, that's pretty easy to prove out, right? You have a restricted list, you've baked it into your compliance monitoring program, and then you can look at the portfolio and see there are none of those restricted issuers in the portfolio. You've got your documentation. But as a lot of active managers use a strategy known as ESG integration, which essentially is you're just looking at ESG factors and you're considering them, and to the extent that they're material to an investment's value. And it's often characterized as being just one tool in a portfolio manager's fundamental toolbox. So it's much more difficult to point to that one buy-sell decision and say there's an ESG factor that was determinative in this decision. But obviously, you do still need to demonstrate that you're doing what you're saying you're doing. So I think there are other, again, practical ways to demonstrate robustness in your process outside of just documenting buy-sell decisions. So on your investment team, you can start thinking about how are you distributing and making research available? Is this on a global platform that's available to all investment professionals and not just those that have ESG in their title? We obviously all in this room probably subscribe to numerous third-party vendor data and ratings, and we also develop our own proprietary research. So making sure, again, that is available to everybody in a prominent way. Building in working groups within your investment team on ESG topical issues. And again, populating those working groups with your ESG experts, but also members of your general investment team are a good way to demonstrate ESG concepts are ingrained in your process. And these are also good ways to kind of, for lack of a better term, kind of congeal a manager's thoughts around a specific topic and really demonstrates buy-in from the entire investment team. And then lastly, I think in your risk management oversight, so you have an investment risk oversight structure, making sure that ESG is a component of that, sustainability risk. You could even consider launching independent or kind of standalone sustainability risk reviews where you sit down with portfolio managers for each strategy at a certain time every year maybe and walk through the risks and opportunities of that portfolio. Again, this is helpful in demonstrating a robust process that you are actually doing what you're saying you're doing in your disclosures.
I want to pause for just one moment for continuing education purposes. The first code word is solar. Yeah, and I think, the risk alert, the SEC's compliance risk alert essentially also emphasized in several different ways that compliance personnel, they found deficiencies in the way that their understanding of the ESG strategies for which they had compliance oversight. And what Brad was talking about is some good ways, and there are other ways of doing it, of course, but there's some good ways of essentially being able to establish that the CCO office really has some understanding of the strategies, and when the Division of Examinations comes in, that the CCO office really was on top of it, made sure that there were appropriate disclosures, that you're doing what you're saying and saying what you're doing, because the SEC is clearly looking at the compliance aspect, not just the investment management aspect of this.
And then maybe lastly on the compliance risk alert is consistency across marketing materials and not overstating the role that ESG actually plays. This, again, is something that will lend itself to, an examination deficiency or an enforcement case pretty easily. So there are a couple kind of practical points that you can take away and maybe incorporate into your process to help at least mitigate this risk. And one of them is having compliance staff that are trained on your ESG techniques and are kind of your go-to ESG reviewers. That way you really you're picking up on the nuances of various ESG strategies. Another helpful kind of tip, I think, that we were actually talking about in prepping for this panel is giving the kind of nebulous nature of ESG in general. These aren't defined terms, and they kind of mean what each manager says they mean. To ensure consistency, though, across all of your communications and all of your departments, developing a firm-wide taxonomy and a kind of a book of definitions of various ESG terms is a pretty good idea. So when you're using terms that can have multiple meanings, such as like sustainability or responsible, at least you've had kind of this agreed-upon definition of how your firm uses this. So again, you have consistency across all of your marketing materials and your RFPs and your disclosures.
Brad, do you want to add anything also about the kinds of comments you're seeing in fund disclosure documents?
Yeah, absolutely. And I think anybody that has a 40 Act product that's had an A filing in the recent years that has any kind of mention of the ESG in it is probably getting standard comments that the staff are lobbying, and one of them being is, give us more color around your ESG strategy. How is it actually implemented? What role does data play in your strategy, specifically third-party vendors, so your ratings and research? And then also, within the ESG space, does one factor play more prominence than others? Do you give more weight to climate change, for instance, because maybe you think it's more financially material than, say, the social or governance factors? So these are common comments that we're seeing. And if I can kind of move into that investment management box on the regulatory space, because we are expecting some updated guidance or rulemaking from IM related to investment company, investment advisor, ESG practices. And at least from what I've seen, it's been pretty open-ended on what will actually be considered. But I think one thing that can be indicative of where IM might be going is these 40 Act comments. Everybody seems to be getting these consistent comments. So I could definitely see the staff looking to codify these in guidance or updated rulemaking.
And one of the things you see in the consistent comments is subjecting ESG to the names rule. I think a lot of people have, in the last 2 years, gotten comments from the staff to adopt an 80% test in fund documents. Previously, ESG had been looked upon as more of a strategy than a type of investment, and therefore not subject to the names rule. But the pressure from the staff, and now 2 different regimes at the Division of Investment Management, seems to be to effectively adopt more stringent tests.
And that is certainly something that is on the regulatory agenda. As everybody knows, there was a public consultation back in 2020 on the names rule, which had a whole laundry list of issues that they were considering, ESG just being one sliver of that. But Ben hit the nail on the head that they're certainly trying to get information on, is ESG a strategy or is ESG an investment type? And I think we could all argue that it's probably both, right? So if you have a green bond fund, that's referring to a specific subset of fixed income securities, probably subject to that 80% test under the names rule. Whereas if you have something like the best-in-class strategy or the ESG integration strategy, that's telling you how you choose investments, not what you're actually choosing. So it's more of an investment strategy. What will be interesting to see when we do get this updated guidance is that Chairman Gensler has obviously made this statement in a number of speeches of, is this historic distinction between investment types and investment strategies even meaningful anymore? And should we go back to the drawing board? And obviously, the knock-on impact of doing away with that distinction would obviously go way beyond ESG, but it's certainly something to keep an eye on.
And I think something we've been seeing, at least for certain branches of the SEC, is they've also been requesting model portfolios to take a look. And I think one of the things they're trying to understand is whether the portfolio would meet sort of a client expectation, much of it which can be handled by greater disclosure. But the example that Brad was talking about, whether you're best in class or not, which might make a difference, for example, whether you exclude all petroleum companies or you pick the one that you believe is most ESG friendly. That's a big difference to clients in many cases. So it's something that the SEC looks at for having maybe more granular disclosure.
Yeah, speaking of the taxonomy, Brad is suggesting to develop the word best in class oftentimes is the biggest source of confusion. And practically speaking, sometimes best in class inclusion is very similar to worst in class exclusion, right? So you don't exclude, you only select certain things and meet certain criteria is the opposite of you're excluding things that don't meet the criteria. And so, but oftentimes it's kind of misleading in the way that people say, is that it? How we differentiate between exclusion and then best in class? Because the labeling sounds a little bit more optimistic if we use best in class. So oftentimes you will see firms actually have additional meaning for best in class when they describe it, in addition to meeting certain criteria. So there's a certain what we call optimization process involved if there's a best in class, the terminology is used. But again, that term is used not very in the same way across different continents, different jurisdictions. So again, to Brad's point, the AMAC recommendation years ago, I think last year, they said they would suggest to use the terminology ICI, Investment Company Institute, developed. But the issue of that is the ICI didn't define everything that's causing interpretive issues. So they serve a good baseline. But there are other things like a best in class and, for example, net zero commitment, right? There's always new terms entering our lexicon nowadays in the ESG space. So the compliance team, the marketing team will have to work together, stay diligent to see what are the new terms, what do they mean to us, what does it mean to other people, practically how we enforce them, how we substantiate the claim. So it would definitely be good practice to review all the terms Not everything needs to be defined, but just to focus on the terms that can cause some exposures. So.
And then, maybe before we slip to the next slide here, just to round it out with the enforcement. So Ben had mentioned this ESG enforcement task force that's been set up. It was announced last spring. I think their mission is to proactively go out there and find ESG misconduct, and they're certainly looking for material misstatements and advisor disclosures and marketing materials. Not a lot of news coming out of this enforcement task force yet. I mean, there are a couple headlines that have been grabbed over the last couple of years. Obviously, we're all aware that Deutsche Bank is under investigation as a result of an EU-based whistleblower. But otherwise, there really haven't been a lot of enforcement actions. There's a state probe that we know about that's going on, which maybe we'll talk about if we have time. There was also a case actually announced, or a settlement announced a couple weeks ago with a smaller advisor that was a religious-based advisor that was offering strategies that complied with Sharia law, so this Islamic law, and essentially just built in a whole slew of exclusions. And ultimately, I think the SEC found that this advisor did not have appropriate compliance controls and infrastructure to ensure that these exclusion strategies were actually being carried out. So that is a kind of important case to take under advisement.
Right, and at least in the public disclosure in the Wall Street Journal, New York Times, and otherwise, it appears the Deutsche Bank situation is revolving around a description of ESG integration into the investment process that may not have been as robust as some of the marketing material tended to lead investors.
Yeah, from a practical standpoint, when we review, there are two deficiencies normally. One is direct contradiction. If you say you're doing something but you're not, or say you're excluding something but you're not, then clearly that's a much bigger problem. But the second category is a lack of substantiation, right? It is like a UN SDG goal is one of the examples. So I think for compliance folks, because their marketing team is churning out lots of materials all day long, so we decided to take a risk-based approach, such as to screen or focus on the contradiction first, because that's the bigger source of exposure. And then do the best to convince the folks to have better documentation, things like that, to help with the substantiation piece, because ultimately they're not going to say secondary exposure, but they cause exposure, but not as fatal to direct contradiction.
So I think we're going to briefly touch upon a couple of other regulatory developments outside of the SEC. Brad, I don't know if you want to talk about a little bit about the Department of Labor's proposed rule, which in effect would change the guidance that had been given just 2.5 years ago under the previous regime at the Department of Labor.
Yeah, absolutely, and I understand there was a separate panel on ERISA developments, I believe, so we won't obviously linger on this, and we want to keep things moving in the interest of time, but obviously we're all aware that DOL's been kind of a soap opera the last 2 years or so with rulemaking around not only shareholder ownership practices, but also ESG, using ESG when investing ERISA assets. And really everything ties back to the ERISA kind of core principles of duty of prudence and duty of loyalty. So, when you're making investment decisions, a fiduciary should consider all factors that are material to an investment's risk return, and then also don't subordinate, a plan participant's risk return interest with other objectives known as, kind of collateral benefits. There's 30 years of sub-regulatory guidance on the kind of incorporation of ESG and shareholder ownership practices under these two broad principles. And, they kind of always hover around the middle, but depending on the political administration that's in office, the meter goes one way or the other. Obviously, 2 years ago, in 2020, the Trump administration kind of rushed through a couple of rules, one related to proxy voting, one related to ESG investing, which, garnered a lot of pushback in the industry, and that they kind of just painted ESG as kind of a dubious economic value, even though certainly noting that ESG could be material and appropriate. And it really led the Biden administration to immediately put an enforcement freeze upon coming into office, and also launching a directive to have the DOL revisit this rulemaking. And late last year we got the proposed rule, and really, again, it is still just tethered to these core principles of prudence and loyalty. But what the Biden administration has done in an unambiguous fashion is said, look, climate change and ESG factors can and often are material to an investment's value, and therefore should be considered by a fiduciary when investing ERISA assets. And additionally, on the shareholder ownership space, noting that ownership rights are an important way of holding management of companies accountable, and therefore fiduciaries of ERISA plans should be voting proxies unless there is really a compelling reason not to, in that it creates some unnecessary burden or some unnecessary cost to the plan. And that's kind of a departure from the guidance under the Trump rule, which kind of painted shareholder ownership practices in more of a different light. So that's maybe all we'll say about the DOL rule, just to, again, keep things going.
Right, and just one thing to add to that, which is, from a compliance perspective, the issue is not that the DOL proposed rule is not able to be complied with. It's relatively straightforward, but if you're managing ERISA money and non-ERISA money together, you have to consider integrating your procedures to make everything jibe, so that it's either very clear where you're doing something differently for one type of account or other, or if you're really following the DOL guidance and applying it also to non-DOL accounts, that they know that in the disclosure. Alan, do you want to talk a little bit about the FINRA regulation?
Yeah, so the jurisdiction really comes from selling mutual fund. FINRA will review marketing materials, for example. I think there's some occasional feedback we got is around what they call ESG risk disclosure. Because again, as we mentioned, that the most common ESG practice out there as of today is still exclusionary based. Let's just say you're excluding the worst carbon offender, or some of them are not that controversial, such as the weaponry and that restriction. But the view appears to be that if we are slicing off a part of the investment universe, there is a perception, at least out there, that if we are foregoing investment opportunity, even though investment teams don't always feel that way, and because if you think about it, traditional portfolio management approach is, okay, here's a universe, S&P 500, and then you apply certain criteria. Only company with good earning will make the second cut, and so on and so forth. The investment team feel that, okay, ESG is simply similar to that traditional approach. We start with a common investment universe, and then we apply certain criteria that we think are universally accepted to some degree. So they don't necessarily see that's necessarily a foregoing investment opportunity. Unfortunately, sometimes the regulator feel that's foregoing investment opportunity, and then occasionally there's a disclosure that needs to be added to the marketing material about potentially foregoing investment opportunity. And the regulator view may evolve at some point, but again, right now everybody's taking a very cautious approach because the incentive in the industry is very high to claim ESG, because active management is under pressure, the passive fund is taking over, margin pressure. ESG obviously adds a bit elements of ambiguity and a necessity for active management. So the regulator's view is definitely there's a lot of self-interest at play for the asset manager to adopt ESG. As a result, to counterbalance that overall investment managers push for ESG, they'd like to highlight the risk side, so overall achieve some overall balance on behalf of the investors. So that's kind of where we are at the moment. But my understanding, legal experts, FINRA maybe operates in a somewhat decentralized way in terms of reviewing marketing material. Maybe at some point we'll consolidate, but we'll see.
Do we want to? Maybe we could briefly touch upon state laws, particularly we know in the fossil fuel industry that there's some states that are trying, at least for their state pension plans and otherwise, to have fossil fuel companies removed from accounts, and we have states that are pushing in the opposite direction. Maybe, Brad, if you could talk a little bit about what you're seeing in that space.
Yeah, absolutely. And this is, I find it to be a very interesting development, and it's not something that really gets a lot of attention. But, anybody that's managing state pension accounts or any kind of state retirement account or just state funds in general, that, you should be aware of what's happening at the state level. And, certainly ESG state level restrictions and laws are not new. They've existed long before anybody even knew what ESG was, right? Think of, investments linked to South Africa during apartheid or Darfur or any other political hot button issue. But what we really have seen in the last maybe year and a half or so is a spike in either final laws or really proposed bills in the firearms and fossil fuel space. And I'll really just focus on the fossil fuel space right now, but the firearm bills certainly mirror these same types of laws. And as you would guess, the kind of the type of law or the requirements of the law certainly depending on the political leanings of the state. But we're certainly seeing activity across the board. So there's really kind of two buckets of laws that we're seeing, what I would, and this is my terminology, anti-fossil fuel laws and then protectionist laws. Starting with maybe briefly just touching base on the anti-fossil fuel laws. So this is pretty much self-explanatory. It's a restricted list. You'll have states coming out saying we don't want pension funds to be invested in fossil fuel companies. So it's a kind of a mandatory divestment. Fossil fuel companies is obviously defined under the law, usually tethered to some kind of revenue threshold or maybe reflecting the top 200 publicly traded fossil fuel companies. And there are things like fiduciary outs, so you don't have a fire sale situation. And there are outs for state funds that are invested in pooled vehicles like mutual funds that are more indirect holdings where the manager of that fund will, under these laws, just get a kind of warning letter in the mail saying, look, your fund, we're invested in your fund and it has holdings that violate our state law. Please consider divesting or setting up a new fund that doesn't have these holdings. But that's where it kind of stops. So there's not really a mandatory divestment from the funds. So that's the kind of the anti-fossil fuel side of things. On the protectionist side, which I think is one more concerning, but also more interesting, obviously Texas has gotten a lot of headlines over the last couple weeks and months because of a pair of laws that went live in September 2021, one dealing with firearms, one dealing with fossil fuels. But I can tell you there are a number of states that are moving forward with bills that are mirror images of these Texas laws. And all you need to do is really read two letters, which I think anybody that has exposure to these types of clients should consider this required reading. And you can pull these letters off just a quick Google search. They're from the state of West Virginia. There's two of them. And while it is on West Virginia's letterhead, these are co-signed by 15 or 16 other states. One of them is addressed to the Biden administration. One of them is addressed kind of an open letter to the banking industry, but can be read more generally as just the financial services industry overall. And it essentially just says, look, we're states where fossil fuel is important to our state revenue, and it's also an important employer of our constituencies. And we're not on board with this federal agenda to transition to a carbon-free economy. We're also not on board with the private sector, encouraging folks to transition to a carbon-free economy. And we're going to take state action to thwart these agendas as we can. So there are two really variations of these types of laws. They're often bundled together. So it's a restricted issuer type law where a state pension fund, for instance, can't invest in a company that's deemed to boycott the fossil fuel industry. And that term boycott is defined in all of these laws and is really kind of concerning because it's boycott in the traditional sense, as we would all understand it, refusing to do business with somebody or terminating a commercial relationship because they operate in the fossil fuel space. But there's always this very broad catch-all that exists in these laws of it can be any action that is intended to inflict harm, economic harm, or otherwise commercially disadvantage a company because it's in the fossil fuel space. That is a very broad definition that you could certainly drive a truck through if you needed to. But that is the definition that's popping up in all of these laws. So the restricted issuer side, again, has the same fiduciary outs and the same outs with respect to indirect holdings and pooled vehicles. But there's another variation of this known as the contract prohibition laws. And essentially it's saying a state or a state entity can't contract with a company for goods or services, generally over like $100,000, if that company has a practice of boycotting using that same very broad definition, the fossil fuel industry. And how that plays out in practice is that at the point of contract, say when you're entering into an IMA, you'll be asked to sign a boilerplate cert saying, I don't boycott as defined under this law, or I won't during the term of this contract, signed CEO or general counsel. The issues that start to pop up under this, I think are kind of apparent, is that very broad definition of boycott could capture things other than what we would think is boycotting. It's not just a bank saying, I'm going to divest from fossil fuel, or a bank saying, I'm not going to lend to coal companies anymore. I think it's broad enough to capture things like net zero commitments, potentially. which are obviously, as we all know, all the rage right now in the asset management industry. I don't know who decided asset managers are the solution to climate change, but that's the world that we live in right now. Could that be deemed to be boycotting a fossil fuel issuer? It's kind of hard to envision getting to net zero in your portfolios without discriminating against the fossil fuel industry at some point, right? And I think it's more than academic. As I noted on the previous slide, the SEC has launched a probe in Texas of banks that obviously banks serve as underwriters for municipal securities. They're subject to these boycott laws. Many of them have had to sign these certs, but also have policies, global policies that maybe boycott fossil fuel issuers. So the SEC is now probing these banks to see, did you mislead the state of Texas or have you misled your investors? That fact pattern could obviously be applied to investment advisors as well. So I think it's definitely something worth watching as that probe develops.
I'm going to take another brief continuing education moment here, and the second word is assessment. That is assessment. So there are other standards that that people are dealing with that apply to ESG management, third-party standards that they agree to comply with, and we're going to very briefly just discuss how these are integrated into some of the compliance programs and some of the issues people are seeing with it. Maybe, Alan, if you could start with the CFA Institute.
Yeah, sure. I work on the member ESG committee for CFA Institute. So obviously the issue here is greenwashing. This is a matter of market integrity. So what we did was we have somewhat similar standards with the SFDR in Europe, Sustainable Finance Disclosure Requirement. But there are some differences, obviously. First of all, the SFDR has a policy goal to direct capital investment to finance sustainability. So that has a policy goal, but the CFA Institute, our disclosure standards does not have that policy leaning. We're policy neutral, so it's more of a fair disclosure regime. The challenge that is, because we would try to use a framework of a GIPS, Performance Investment Standards, we think is very similar. But the challenge of that is the ESG world, there are three categories of things, activity. One is the intention, like the commitment, like UN SDG, so on and so forth, UNPRI. The second one is the activity, right? So you use MSCI rating, ESG rating in your investment process, but it's not always clear how that manifests into investment decisions, but they are categorized as activity. The third one is the outcome, the results. I mean, the most straightforward example will be exclusionary, right? So if you want to exclude certain sector, make sure the outcome does not include, the portfolio holding do not include those prohibited names. So we're developing verification procedures for each category. The question is really about what type of evidence record keeping needs to be maintained to substantiate each category. The hardest one is the intention and the activity. The outcome is not that hard to verify. It's more black and white, but it's more, as you guys know, you've seen a lot of ESG claims. A lot of those disclosures are at the intention and the activity level. But all in all, we think the difficulty at the beginning was, how do we develop a governance framework without a legal definition of the very term ESG we try to regulate? And then quickly we realized that this is not really a matter of legality, it's really a matter of a popularity. Whoever is most successful promoting certain terminology is probably going to be the most accepted one. So we stay away from defining terminology ourselves, but we're just compiling a bunch of terminology from different reputable institutions. So for transparency, folks can develop their own lexicon at their own preference. So that's the approach where we've taken, and the timeline is the disclosure standards has already been published last year, November. We're aiming to finalize the verification procedure May 2022, because as we all know, verification procedure is crucial because the rule is only as good as it can be enforced, right? We all know that. So that's why that's the goal for the verification procedures. So.
And that maybe brings us to one of our questions is, how easy is it to develop a global taxonomy if you're an international manager and subject to various standards?
Yeah, I mean, obviously we're French. We're in the jurisdiction of SFDR, and obviously the other difference is SFDR has two layer of requirements. One is at the product level, the other one is at the entity level. As Brad mentioned, that there's a view in the European Union that financial service industry should play a much bigger role in sustainability. So a lot of those entity level, oftentimes if a US subsidiary of a global company try to implement the framework, we have to decide which one is probably we have to opt out, especially at the entity level, because we're not a jurisdiction there. Typically, asset manager can self-impose certain restriction, and unless it's in the contract IMA with the client in specifically. So yeah, there's numerous nuance on that, and also the other part is obviously European Union SFDR has Article 6, Article 8, and Article 9. It's obviously different, 50 shades of green, I guess that's what we call it. The Article 6 is basically the baseline. Article 8 is you have to promote sustainability. And Article 9 is that your investment objective will have to include some aspect of sustainability. But from a disclosure standpoint or from an investment decision standpoint, that seemed very clear in the EU. But in the US, we're not, because we don't necessarily have that policy orientation, we're still at the early stage of developing rules, which are mostly focused on disclosure. Now, one last thing I want to mention is that the biggest difference, perhaps, because we all hear the term materiality, right? So for the CFA Institute, or most of the US, I guess the regulatory focus is material means financially material, right? If climate change is potentially detrimental, that's because it will hurt the company's bottom line, hurt the profit, hurt the investment performance. But in European Union, there's a definition called a double materiality. Essentially means it can be financially material or just environmentally material. So a lot of decisions over there are made based on that assumption that double materiality needs to be considered. So that drives quite a lot of differences, as you guys can imagine, when you kind of try to implement a policy on the ground. So.
I don't know, Brad, if you want to put in a last word on other standards before.
Yeah, just to kind of round this out. I think the risk here, obviously, is that our voluntary or international standards that managers sign up to, pushing even non-EU or non-ESG managers to becoming more ESG. And so it's certainly something to keep an eye on from a fiduciary standpoint, right? Are you agreeing to these voluntary standards that are infringing potentially on how you manage money for your clients? And if so, you need to start considering things like updating disclosures at minimum, but also notifying your clients, and maybe even in certain cases getting pre-approval and thinking about updating things like investment guidelines if, again, there is such a material impact on, again, how you're managing money because of these standards.
And we've touched upon probably almost everything on this slide as we've gone through things. So maybe it's just a good point to sort of, as we get to the end of our panel today, just to sort of summarize maybe a couple of things. I mean, one thing that I would note is I think one of the themes of this panel is for global firms, they have competing ESG considerations both inside and outside the US. And one of the compliance challenges is to try to integrate all those or to properly describe where you're really separating your management for different types of clients in different jurisdictions. Another constant issue here is the policies and procedures, and the challenges as to whether you have separate ESG procedures or you integrate them more into your total compliance framework, but that definitely it should be considered that there are some both disclosure and record-keeping aspects of this that really should be thought about when you're updating your procedures. We've talked a little bit about consistency across all materials. There was a question from the audience about responding to RFPs and questionnaires and other things from clients, and I think you should assume that if the SEC came in and looked at those materials, they would treat those the same as they would treat marketing materials and subject to the same anti-fraud rules. And that takes us, of course, to examinations. Examinations is clearly very focused on ESG. The mandate from on high at the SEC and probably some other regulators is to look very closely at disclosures and record keeping and the basis for both recommendations and any, performance or other representations. Fiduciary duty, I'm going to turn to Brad. Maybe he has something that he would like to add there to what he previously said about the particular issues under the Department of Labor, but also sort of generally under the Advisors Act.
Yeah, I mean, again, I think it hits, this cuts across multiple areas. So, if you're a global firm and you, kind of manage money on a global platform basis, how do you grapple with the divergence in international regulatory standards? So, Alan's obviously talked about SFDR in the EU. So if you have a UCITS and a 40 Act fund that are clones of each other, are you getting to a point where that can no longer be possible? Without potentially having a fiduciary duty issue in the US at least. Same with the kind of international standards, again, pushing folks that maybe don't consider themselves to be ESG managers towards having to integrate ESG concepts. And does that, again, cut against what you've told your clients you're doing when you manage their money? Back to examinations too, just one point here is, and nobody likes really to get audited, but we all have internal audit departments, and maybe doing some kind of bespoke exam focusing on ESG and training up your audit folks so they know what you're doing in this space, so at least you can maybe discover issues that before a regulator obviously does, if there are any. So I think that's maybe a good idea as well.
I think my last thought is, on proxy voting, this is sometimes the forgotten part of ESG. The G, effectively, the governance. There's obviously been a repeated push by regulators, both the Department of Labor and the SEC in various ways, to have people, to have advisors in particular, have both detailed policies on when they will and won't vote. If you're representing yourself as being ESG compliant or an ESG firm, this may sometimes place a higher burden on voting in certain circumstances, on governance, than you otherwise would if you were just a regular active manager, or at least describing or to clients why you don't think voting is appropriate in some circumstances. And I'm going to pass to Alan if he has any final thoughts before we wrap up.
Yeah, proxy voting is interesting on 2 points. One is on the ESG space, we call that engagement, because proxy voting is a technical term, only it's restricted for the equity strategy, right? For fixed income, you can't vote because it's just about the nature of security. But if we have a big enough size, sometimes you can do general corporate engagement. Oftentimes, from compliance and marketing perspective, that's where a lot of exposure comes in. So it's very important to look into both different asset classes, different activity, both really try to influence. The other point is, as Ben mentioned, that proxy voting used to be considered peripheral investment activity, or not even considered investment activity at all. But now with ESG, because there's one of the very powerful venue to express your ESG view, it's become a much, much more important part of the investment activity. And if you guys read the press, like engine number 1 against the mighty ExxonMobil, with such a small fraction of shares, somehow leverage the relationship, leverage the message to manage to change the board members. So that become a much topical issue now in terms of how proxy voting plays in the role of overall investment management process. It's a good opportunity for us to actually have real portfolio management engagement in the process internally.
I want to take this time to thank the audience for persevering through ESG and thank my fellow panelists. And we hope that you enjoy the rest of the conference.